All right. Today is Wednesday, the 25th of January, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's start by this. Initially, when the market opened down in the morning due to Microsoft's earnings, or lack thereof, I thought, you know what? This is actually bullish, because all of this euphoria that has been going on since year to date, with the market rallying, certain names rallying 20-30%, the trashiest names of them all, moving higher, the sentiment is changing, everybody's saying the bear market is over, everybody assuming that the Fed is going to pivot and pause and cut and all of that. But now that we got a reality check yesterday that corporate earnings are actually bad and the Fed is not going to come to the rescue, and even if it does, it's not going to get us out of a recession. The recession is going to happen, corporate earnings will get hit, and stocks will go down further. And I thought maybe the market got the memo, and now it's going to go down and wash out all of this extreme bullish sentiment that has been going on year to date, and all of these false assumptions of the Fed doing this or that. And if that happens, it will be a good setup before the FOMC and before the chairman of the Fed, Jerome Powell, speaks. Because if the market heads into the FOMC battered and bruised and with extreme negative sentiment, then that will allow the chairman of the Fed to become more relaxed and maybe give us a date in a clear timetable on when the Fed is going to pause and hold interest rates, and perhaps, maybe, it will push him to speak in a dovish tone. And that will be really good for the equities market. Even if the market acts in a mature way, in a cautious way ahead of the FOMC, that could do the job. But if the market heads into the FOMC euphoric, with extreme bullish sentiment, assuming that the Fed is going to pivot, the Fed is going to cut rates, inflation is over, the soft landing is here, this will push the chairman of the Fed and force him to come out to pour cold water on the rally by being perhaps more hawkish than he should. So today, when we saw the so-called comeback, when market participants decided to buy the dip in an extreme fashion and push the charts basically in the Dow Jones, S&P, NASDAQ all the way to the neutral line again, after being down at least in the NASDAQ by over 2% in the morning, I thought to myself, okay, here we go again. They want to run it hot. They want to fight the Fed all the way till the meeting. And then the chairman of the Fed will have no other choice but to drop the nuke and annihilate all of them, ending this year-to-date rally based on whatever optimism. And hence, those of you who look at the action that took place today as bullish, you have no idea what you're talking about. You should have actually hoped for the market to move down and continue to go down all the way till the FOMC, because the risk versus reward becomes the chairman of the Fed will be easier on the markets and maybe allow a rally to go ahead. You see, a lot of you say, hey Maverick, what will make you question your bearish thesis? My answer is number one. I just told you. If the market actually goes down and act battered and bruised with extreme negative sentiment, then the odds become that the Fed will give the market the carrot, not the stick. Number two, what will make me question my bearish stand is if Marko Kolanovich from JP Morgan Sachs comes out and capitulates and becomes bearish. And whoops. Look at this. Outright negative on stocks. JP Morgan's Marko Kolanovich braces for correction and hard landing. Wow, what happened? This is the guy who've been telling us last year that you gotta buy the dip over and over and over and over again. Now he's capitulating. Now he's going the other way. And that makes me question my bearish stance. But all joking aside, let's take the events that unfolded today one by one. In the morning, perhaps contributing to the negativity that took place in the equities market, the news that we got from Australia. Listen to this. You say that inflation is dead. Yet down under, Australian inflation hits 33-year high on energy costs and tourism rebound. Prices went higher by 7.8% in the fourth quarter. What does that mean? The Australian bank will raise interest rates higher, which, by the way, will push the dollar down in the long run if the Fed takes a stance of, oh, we're just gonna do the 25 and then pause and hold. The US dollar will get crushed like you have never seen before, and this will push commodities prices higher and higher and higher. And of course, in Australia, the living crisis worsens. Electricity costs, unbelievable. Real estate prices, sky high, out of control. And therefore, the Australian bank will come out as hawkish as they can. And the news from Australia shattered the assumption by the bulls, who are buying bonds assuming that inflation is over, the Fed will stop tightening, yada, yada, yada. The news from Australia was a setback, a major one. You combine that with the news from Microsoft last night, the slowest growth for Microsoft in a decade, and the margins, of course, are collapsing, and the market took a massive hit right in the chin. But then came the Bank of Canada with the rescue. The Bank of Canada raised rates by 25 basis points, but they made it clear that this will be the last one and they're going to pause. That immediately fueled optimism in the market here in the United States that the Federal Reserve will do the same. They will do the 25, and Jerome Powell will come out and say, okay, this is it, 25, and we pause. And the market assumes that if it rallies ahead of the FOMC, they will get their cake and eat it too. Not knowing that the chairman of the Fed, if he looks at the market rallying significantly higher into the FOMC, he will have no choice but to take a hawkish stance to scare the market away, even if it goes against his own will. Although the market did not pay attention to this. Remember, the bond market, the equities market here in the United States is assuming that the Fed, and pricing in, by the way, pricing in that the Fed not only will go to 25 basis points, pause and hold, but they're going to cut rates. Absolute delusion. And today, the Bank of Canada made it clear that while they're moving down to 25 basis points and pausing and holding right now, they're not even thinking about cutting rates. My hunch is, my sources say, that if the market rallies all the way till the FOMC, you will hear Jerome Powell coming out and saying we're not thinking about cutting rates. That will seal the deal in this year-to-date rally, that it's over. But here's the problem for Powell. The market right now is in a mode of looking for anything, any source of optimism to cling on. Maybe even if Jerome Powell comes out and says we're not thinking about cutting rates, maybe that's not going to cut it. No pun intended. And therefore, unfortunately, for the economy, of course, if the chairman of the Fed really and seriously intends in ending this market versus the Fed that continues to go on, he has to produce a shock. And a shock will not happen unless he goes 50 basis points, not 25. That will end the rally once and for all. We will see the capitulation and the end of the market fighting the Fed. Now, will Powell do that? Probably not, because Powell is spineless, after all. He's being influenced, of course, by the vice chair, Madam Braindead. But the good news is, for the Bears, of course, not so much for the Bulls. Madam Braindead is now being recruited by the Biden administration to replace the BlackRock disaster, Brian Deese. Now, I'm not sure why Madam Braindead will downgrade from a prestigious position, the vice chair of the Fed, to become some tool propagandist for the regime, but to each his own. And here's the problem. For the Fed, the doubters, the people who say that inflation is dead, it's over, the Fed has to pivot right now. Have you forgotten that inflation will come back the moment the Federal Reserve backs off? Have you forgotten the law of aggregate demand? Well, here's your reminder. Now that mortgage rates went down, just by a tiny bit, look at how the aggregate demand is kicking in. Weekly mortgage demand jumps by 7%. This is the sharpest increase in years. The moment prices pull down by a little bit, the moment the Fed relaxes and interest rates move down, you will see the stampede resuming again, and inflation will rebound higher, making higher highs. But you're crazy, Maverick. Why would inflation make a higher high? Because of something called expectations, something called psychology. Go back to the 1970s and look at what happened every time inflation dips down. It comes back better, stronger, with more ferocity and viciousness. Every time the administration and the Federal Reserve relaxed in the 70s, inflation came back. Until, of course, legendary Chairman Volcker put an end to inflation by doing the job and sticking to doing the job. Will Jerome Powell do the same? I don't know. Maybe he will. Because look at what's going on here. The mania is not over, folks. The amount of money and liquidity in the system right now is not down enough to kill inflation. The headline reads, millennials are buying multi-million-dollar homes via TikTok as the property porn, quote-unquote, captures the next generation of luxury buyers. Yeah, I know, inflation is dead, right? Think again. But of course, the inflation is dead crowd is now also saying the bear market is dead. Matter of fact, a new bull market just started. Well, I got some bad news for you. A warning from the Big Short, Michael Burry. Without further ado, here it is. In focus tonight. Maybe. What did the Big Short, aka Cassandra, mean? This is the tweet by Michael Burry, the Big Short, on Twitter about a day ago, I believe. He shared a chart of the aftermath of the dot-com bubble, the bear market of the 2000s, specifically a period from the fourth quarter of 2001 all the way to the second quarter of 2002. Now, some of you old-timers remember exactly what took place back then, but I'm going to refresh your memory. At the same time, explain to you what Cassandra means by this tweet. And perhaps Dr. Burry, I don't know, but I have a hunch. Maybe he's watching the show. Because back in January 10th of this year, I said this in my program. Take a look. There was a rally coming, and the rally is here. It is still within range. It did not break the resistance yesterday, but it could do it tomorrow. It could do it after the CPI. A matter of fact, we could see the SPX moving higher above the sloping line of resistance, and that would be a major source for the biggest orgasm you've ever seen in Wall Street, at least in a long time. Because everybody's going to assume we're out of the woods, we made a higher low, we've broken above the pattern of resistance, it's gone. The bear market is over, folks. They're going to have Tom Lee on TV every single day saying the market will go higher by 20, 30, 50, 100%, and everybody assumes that we're out of the woods. The rally might actually take us all the way to 4,025.28, which is resistance, and then, when everybody feels comfortable that the bear market is over, they pull the rug. Haven't we seen this before? The answer is yes. We go back to the dot-com days. In the 2000s, as you can see, bear market, we have a sloping line of resistance, just like we have right now. And then around 2002, beginning of the year, we see a rally forming a higher low, breaking above the resistance. Everybody feels, okay, it's over. We're in the clear right now, only for the market to flush down big time later in the year. My hunch is we will see the same phenomenon again this year. And of course, what we see in the market right now, look at the weekly chart for the SPX, the cash index for the S&P 500. It is now above the sloping line of resistance, meaning the resistance has been broken, meaning, technically speaking, if the week closes like this, the bearish trend is over, which also means that a new bullish trend has been born. On top of that, the technical setup couldn't be more deceiving because it is convincing. We have a reverse head and shoulder formation, which is known to be a bottoming formation, a bullish formation, and on top of that, you see the yellow line in the chart? That is the 200 days moving average. The chart of the S&P 500 did break above the 200 days moving average. In Technicals 101, this basically means a reversal from a bearish trend right into a bullish one. So Maverick, technically speaking, the bear market is over. It's done. Why bet against the market right now? Why not chase the rally higher? Because I have FOMO. I'm afraid of missing out here. Maybe this is the bottom, or we're moving higher from this point on. I missed in 2009, I missed in 2020. I don't want to miss on this one now. Well, here's a reminder for you. We have to go back in time to 2001, 2002, the aftermath of the dot-com bubble, the most extreme mania in stock market history. Since the top in 2000, all the way to the second quarter of 2002. The stock market, in this case the S&P 500, has been in a bear market territory, with clear resistance line as we see today in the charts. And this resistance line, the sloping line, has been acting as resistance over and over and over. Every time there's a bear market rally, it stops at the line exactly as you can see right in front of you. Until early 2002, when the market did cross and successfully closed above the line for the week. And oh, by the way, it did also close above the 200 days moving average, on the daily chart, of course. Back then, the technicians and the traders said that this is a sign that the bear market is over. And we saw a mini rally, and of course, the trashiest dot-com names that were down 70-80% led the rally, as we see exactly today. And then what happened? It was proven to be a bull trap. The market then melted down and continued to go down and down and down throughout 2002 until the actual bottom took place. And the actual bottom, by the way, was retested 3 times. So it wasn't just, oh, we snapped back and here we go, we have a V-shaped recovery. It doesn't work that way, except in 2009, of course, and I'm going to tell you why. But before we do that, the reason why I went back in time and I showed you the charts, and perhaps what Dr. Burry is also referring to, you're going to hear all of these headlines now. That we have a technical breakout in the S&P, and you're going to see folks saying, oh, we have a golden cross. We have a crossing above the 200 days moving average. We have a crossing above the bearish sloping line of resistance. The trend is your friend, and the bearish trend is over. And here comes a new bullish trend, only to be proven as one of the best traps in stock market history. Because as I said before, bear markets don't end until 2 things happen. One of the 2. Number 1, the Fed comes to the rescue. This is exactly what happened in the 2009 case. Or number 2, most participants give up on investing in the stock market. And this is the case in 2002, when the market ran out of sellers and the sentiment became extremely daunting. The same folks just 2-3 years ago who perhaps decided to change careers to become traders and brokers, and they made thousands if not millions of dollars amidst the mania. They were the same people who said the stock market is rigged, it's over, the stock market is never coming back, yada, yada, yada. It was that moment when the retail trader, the retail investor, the mom and pops gave up on the stock market altogether. That's when the bottom actually took place, and a new mania, a new bubble was born. And guess what? One of the greatest investors of all time, perhaps the greatest, Warren Buffett. What do you think he was doing back at the time? While everybody was chasing the mania in the dot-coms, Warren Buffett stayed away. And he was called a boomer, an old man, irrelevant, a dinosaur, he doesn't understand the dot-coms, yada, yada, yada. Warren Buffett stuck to his guns, buying value companies. And in the years 2001, 2002, even 3, all the way to 4, he was actually preparing for the next bubble. He was buying roofing, plumbing, carpeting stocks, betting on the housing mania that's about to come. And these kind of stocks and these kind of companies are the ones that led the next bubble. In other words, if you assume that the same names who led the bubble back in 2020, 2021 will be the same names that will lead in the next bull market, you have absolutely no idea what you're talking about. In the aftermath of the dot-coms, it took years before technology companies made a comeback. And the bubble was led by different stocks, the housing stocks. In the aftermath of the housing crash, it took years and years for housing stocks to come back. And the mania was led by another group, the technology stocks. This time around, the assumption that the next bull market will be led by these chip stocks, the technology cohort, the high beta kind of stocks, the trashiest stocks with no fundamentals, on the verge of bankruptcy, and still overvalued. If you think that these are the names that will lead the new bull market, you have no idea what you're talking about. So we have a lot of false assumptions going on right now. But when we talk about the end of bear markets and the beginning of new bull ones, what are we looking for here besides the change of formation? Well, back to the tweet. The Fed comes to the rescue, number 1, or participants give up on the stock market. Well, we know that number 2 didn't happen. It's going to take a lot of time and a lot of pain for it to happen. But it seems that the market right now is betting on number 1, that the Fed will come to the rescue by backing off their tightening of the monetary policy. My response is, why would they? Because recently, since the latest rally in the stock market, look at what happened. Financial conditions loosened to become the easiest since February of 2022 when the bear market started. This is why fighting the Fed will be a losing endeavor. This is why, if the rally continues all the way to the FOMC, Jerome Powell will have no choice but to end the rally and come out even more aggressive. So technical breakout or no technical breakout, this is how traps are born. Furthermore, in any recession, and if the case right now that we're going to have a recession in 23, as the yield curve inversion, for example, the most reliable indicator, is saying, if that is the case, we look back at each historical recession that we had. The drawdowns in the S&P 500 and the EPS, earning per share, we haven't even started. We usually see drawdowns exceeding 10% and then some, in certain cases going down all the way to 50%. What we have done so far is nothing. The drawdown in the S&P 500 so far exceeds 20%. Okay, no problem. But the drawdown in earnings per share, EPS, didn't even start. In other words, what you have seen in the bear market so far is just warming up. The bear market is just warming up, yet you say it is ending and a new bull market has been born. But I know, Maverick, we're not going to have a recession. This is going to be a soft landing. You sure about that? Are you willing to bet on that? Because besides the yield curve inversion, look for example at a piece of data that we got this week. Leading economic indicators dropping like a stone, deep in negative territory. So you're saying that the yield curve is lying? You're saying that leading indicators are lying? You're saying that the PMIs are lying? Is this a fight you really want to be involved in? And I say that the current change in monetary policy for removing liquidity out of the financial system in response to a once-in-a-century inflation is a seismic shift that we have never experienced before. Do you really think it will end this easy and a new bull market just started? Question mark. Think again. And I also said this, I love how every time we get a bear market rally, the same comments come out criticizing me as a perma bear, only for these same investors to fall into yet another trap. The purpose of bear market rallies is to vacuum the remaining wealth left in the market. So watch out here. And these, of course, the same folks who said in 2020, this time it is different. It's not the dot-com. It's not 2008. In 2021, they said, oh, but inflation is transitory. Last year, 2022, they said monetary tightening will end up in a soft landing. And now in 23, they say, oh, the bear market is over. And of course, the sentiment is getting really, really alarming out there. For example, I'm not picking up on the commenter here. I'm just giving you an example. The viewer says, I don't care how right Maverick is. The market is going to SPY 430 ASAP. Any evidence for that? Maybe it will, but provide some evidence, please. It doesn't matter what the earnings are because the market will ignore earnings and run the fake CPI. Do be not trust the bears. Okay. Anyways, they will bankrupt you. Trust me, I lost $350,000 in the last few months playing bear. So this guy's a pussy bear. I mean, you can tell from the tone. The bull market is just starting. Go back and fact check every massive pump in the last 5 months. The bear market didn't even start. You're right on this one. The bear market didn't even start. It's just warming up. And by the way, you say that you lost $350,000 in the last few months betting against the market. How did you lose $350,000? Because when I look at the chart, here's a monthly chart for the Qs. Since the top in 22, and even after the rally year to date, the Qs down by about 29%. And in the last few months, as you say, the market has been consolidating. It did nothing at all. How the hell did you lose $350,000? I'll tell you how. You gambled. You're a degenerate gambler. You went all in, buying puts, weekly expiration, I bet, and you assume that the market is going to crash just because you bought weekly put options. And it's going to crash this week. And guess what happened? You lost your money. That's gambling. That's not investing. That's not trading. That's gambling. So my friend, an advice, maybe you should revise your trading quote-unquote strategy. Maybe you're taking a lot of risk here by buying weekly expirations, by going way out of the money, assuming a crash will happen today, right now. That's gambling. That's not investing, not even trading. Here's another one. The viewer says, Mav, your biggest weakness is your tendency to fade every move. We are in a bear market, and in bear markets, you fade rallies. Just like in bull markets, you buy the dips. Anyways, why not grow some balls and stick to the trend? The trend is your friend. What trend? The trend that is down? And ride it instead of fighting it. Okay. Like your failed calls on natural gas, Dixie, etc. Man up and follow the trend. Man up has nothing to do with it. In this game, you gotta be smart, not stupid. And congratulations, you got 2 calls that I got wrong, at least for now. So I didn't get them right yet, that the dollar is gonna pop and natural gas will also rally again. But these are the same people, by the way, back in 2020 who said, oh, this is gonna be different. This is not the dot-com bubble. You're a boomer. You're missing out. Yada, yada, yada. But I was looking ahead, just like your boy Warren Buffett, when he was looking ahead to the next bubble. I was looking ahead to the crash. And by the way, you're the same guys who said that GameStop will go to the moon, AMC will go to the moon. We're gonna stick it to the man. And guess what the man just did? He shattered the record. Ken Griffin's Citadel made $16 billion last year, the largest annual hedge fund profit on record. So all of the money from the mania, the genius mom and pops poured into the market, it went right in the pockets of the man. The man won. And the purpose of these stupidity bear market rallies and the bubbles and the manias is to suck the wealth away from the mom and pops, the retail crowd, the regular Joe and Jane, and transfer that wealth all the way to the top, to the oligarchs, just like the man. And that's what really burns me. That every time we have a mania bubble, what happens is a transfer of wealth from the regular folks to the rich. Every single time. The regular folks chase the mania, thinking they hit the jackpot. This is it. They're gonna get rich, only for the rug to be pulled. And the predators, the oligarchs, end up winning. In other words, all of these people are just tools for the oligarchy. And that's what really pisses me off. And I'm afraid this time around, it's gonna be yet another one. The crowd is gonna chase the rally. They're gonna give them all of these false signs. Above the 200 days moving average, above the whatever technical indicator you want to look at, the mom and pop stampedes, and then they pull the rug, and the same guys, the same sharks end up winning over and over and over again. And with that out of the way, let's move on to cover the stock market information for you, and we begin with the closing of the indices today, and here we go. Steep declines in the morning, but the indices managed to close pretty much on the flat line. The Dow Jones Industrial Average up by 9.88 points, or a gain of 0.03%. The Nasdaq down but beat flattish. Big comeback after the early morning declines. The Nasdaq managed to close down by 20.91 points, or a decline of 0.18%. The S&P 500 in the red by 0.73 points, or a decline of 0.02%. When we look at the sector's performances today, leading the pack at number 1 and capturing the gold medal, materials. Number 2 for the silver, cyclicals. Number 3 for the bronze, financials. The laggards, on the other hand, led by utilities, communication services, and and industrials. Of course, no theme here, all over the place, and the reason is earnings. Boeing was down early on in the morning, and that impacted the industrials negatively. We also got earnings in materials by Freeport McMoran, and that had a positive impact on materials all in all. Now, when we look at the advance to decline ratios, pretty much in the flat line, neutral here. The NYSE 56% advancing versus 43% declining. The Nasdaq 47% advancing versus 51% declining. On to commodities, what do we see here? The dollar is in a pause mood. My hunch is it wants to pop, but it needs a catalyst. What will be the catalyst? The only thing that I can see this week is the core PCE inflation rate. The other thing is the FOMC. But commodities will sniff the move ahead of time. And maybe this is why we're seeing energy commodities weaker today. Crude oil, WTI, Brent oil flattish for the day, be it slightly positive. Although we saw negative activities for the rest, gasoline and RBOB down by about 2%, heating oil down by about 1.75%, then natural gas, the massacre continues, down by almost 12% for the day. Now, when we talk about natural gas, the viewer says, can someone explain why the LNG facility come back online would cause natural gas prices to go up? Would an increase in supply actually cause the price to fall? You're right, but if the Freeport LNG facility is back online, it means that the demand from Europe and Asia, large consumers of natural gas, are now buying from other destinations because our facility is down. When they know that our facility is back online, that demand shifts back to US natural gas. So this increase in demand pushes prices higher. Now that is what it's supposed to do. But the problem is, I know a lot of folks believe in manipulation, that natural gas is being manipulated by JP Morgan, whatever. Besides that, the fact that we're seeing a warmer winter season in Europe, for now the demand is low either way from European consumers. Therefore, natural gas, you're right in this case, that Freeport LNG coming back will actually increase the supply, but the demand is low, and that pushes natural gas prices down. In the meantime, but folks, it's just one storm away, and natural gas supplies in Europe will go down dramatically, and they have to refill for winter 23. Now, it doesn't appear that we're going to have a peace with Russia anytime soon. We're sending tanks. We're talking about sending planes to to Ukraine, which means the war will intensify. So where will the Europeans get their natural gas for winter 23? Think about that. And the answer is, it has to come from the United States, and therefore, sooner or later, we will see a historic short covering rally in natural gas that will exaggerate the move to the upside, and the end result will be pushing gas prices here in the United States for consumers higher. In other words, we have more inflation coming in the pipeline. This is what the geniuses who say that inflation is dead are not paying attention to. Anyways, when we talk about oil this time around, what are we seeing as of late? Prices at the pump moving higher. Another alarming sign for the inflation is dead crowd. Now, why are oil prices moving higher as of late? The answer is because the Joe B administration is not depleting the SPR anymore. So that headwind is now removed. And here comes the tailwind for energy prices to move even higher when the Joe B administration finally decides to replenish the SPR. Now they say, hey, we're going to wait till 70. 70 is not going to happen. At some point, they're going to panic and start buying at 80, 85. And we will see a massive run in crude oil prices. That will shock everybody. And therefore, I say to the chairman of the Fed, if you wimp out right now, it will be a historic mistake, the likes that we have never seen before. And inflation will indeed rebound. And not only that, but also make a higher high. CPI 10% plus if the Fed makes the mistake. Anyhow, back to commodities. What do we see here? We have mixed action in softs, but look at this. Coffee futures leading the pack with gains of almost 2%. The rest, modest gains here and there. Sugar up by 1%. Cotton up by a little over half a percentage point. But cocoa, OJ, lumber futures all muted for the day. When we look at metals, we have mixed action. Platinum, palladium down in the red, but gold, silver, copper, the precious metals are moving higher. So we have mixed signals here when it comes to what the dollar is about to do. Energy prices say the dollar is going to pop. Gold, silver, copper for now. They say, oh, maybe not right now. Maybe the dollar will continue to go down in the meantime, all the way to the FOMC. And of course, we don't have any notable action for meats. And when it comes to grains, muted reactions across the board. The notable winners, number one, soybean meal futures up by a little over 1.5%, and then we have soybeans up by about 1%. Moving on to the big casino, the options market, and what do we see here? The volume made a comeback. So we know that a lot of folks bought the dip using call options. We know that a lot of folks made bets against the market using put options. And therefore, the spread is pretty much 50-50. Yet number one, the hottest table by far, is Tesla, the souffle, with around 1.5 million contracts traded today. About 53% of those were puts. I believe Tesla's up after hours, but you can't bet on that because it's going to open tomorrow and the stock is going to do whatever it's going to do. Amazon at number two with around 1.2 million contracts traded today. Look at this, 50-50 between puts and calls. And Apple at number three with around 970,000 contracts traded today. About 51% of those were puts. On to the unusual activities that took place in the options market today. We begin with the ticker USO. We have a call spread here. USO is the United States oil fund. So somebody sees oil prices moving higher. And they bought the 74 calls and they sold the 76 one. All for the expiration date, February 3rd, with expectations that USO will move higher by the expiration date by more than 5%, but not more than 8%. They paid around 50 cents a piece for buying the 74 calls, and they received about 20 cents in credit for selling the 76 calls. All in all, the entry cost is reduced to about 30 cents a piece. That brings the total all the way to $200,000. Next, we have the ticker MA MasterCard. I believe the name is reporting earnings this week, and somebody see it going higher. They bought the 415 calls for the expiration date, February 17th, with expectations that MA MasterCard could move higher and gain more than 9% by the expiration date. They paid around 85 cents a piece to enter this trade, all in all, spending around $700,000. Then what about the ticker XBI for the biotech ETF? Somebody's betting against the name here. They bought the 82 puts, and by the way, the XBI is a winner year to date, so somebody's fading the rip here. And the expiration date in this case is February 17th, with expectations that the XBI will lose more than 7.5% of its value by then. They paid around 85 cents a piece to enter this trade, all in all, spending around $500,000. On to the heat map. What do we see here? Any theme? The answer is we don't have a theme. And the reason is the majority of the moves are done via earnings. But, and I did talk about it in Discord today, I did buy the dip. Not in Amazon, not in Google, not in Microsoft. I did buy the dip in the names that got dumped year to date, specifically the food consumer staples. I believe we will see the rotation back to value from growth. And if there is any theme that we can extract from the action today is perhaps the beginning of that rotation of the rotation. Leading the pack higher, for example, big pharma names. We see the food consumer staples catching a bid. We see recession type names also catching a bid, such as Philip Morris, such as McDonald's, such as Budweiser, such as Kroger, such as the utilities/communication companies, AT&T, Verizon yesterday, T-Mobile today. And of course, when we talk about value and the losers for the year, the winners for last year, where's the opportunity? What about defense contractors? LMT, Raytheon, all moving higher today. Of course, the exception is General Dynamics, but we're going to send tanks to Ukraine. So that is good news for General Dynamics because we have to replenish them. So this is where I see the opportunity residing. I don't see the opportunity in buying the dip in Google or Meta or Microsoft. I mean, Microsoft told you, hey, the trend will be deceleration of growth right now. And your response is to buy the dip. That's delusion, of course. Now, here's a question from the viewer. He says, is Johnson & Johnson good stock for a bear market? ? The answer is it depends on what stage of the bear market you're talking about. The earlier stage when the inflationary stocks led, of course, Johnson & Johnson did not do pretty good. But this is the stage right now, the recession stage, where names such as Johnson & Johnson, AT&T, Verizon, the boring names will be the winners. And the reason is Johnson & Johnson happens to be a necessity. When the consumer cuts spending, are they going to cut spending on necessities and medicine? I doubt it. Furthermore, perhaps the biggest consumer for these big pharma names, be it J&J, Pfizer, whatever, is the government, Medicare. Medicare is going to stop spending because we have a recession? Of course not. The government right now is spending on steroids. And therefore, I say the big pharma names, the defense contractors, the dip in these names, opportunities to buy. Now let's talk about some corporate news here, and we begin with the tsunami of layoffs. Once again, an update on the brutal and inhumane layoffs in Google. Yesterday, we talked about a Google employee who'd been with the company for over 20 years and got fired via an email. We talked about a pregnant employee who got fired too. Today, we got the news that a married couple with a 4-month-old baby were both laid off by Google while one of them was on paternal leave. Wow, absolute brutality. These companies owe you nothing. as an employee. Don't take it for granted that your job is in the bank. These companies are beholden to investors. They're beholden to that dollar. They're beholden to money at the end of the day. And when the margins are going down, when the stock price is going down, investors will demand from the company to initiate more and more and more layoffs. And of course, the public is reading these brutal headlines from the layoffs in Google. And now the CEO Sundar Pichai comes out defending the layoffs, saying, hey, we also cut our own executive bonuses. Come on. You took $1 million away from your $25 million package? Okay. And then the tsunami of layoffs continues. After the bell today, we got IBM laying off thousands of employees. And the ballpark figure is around 4,000. Then we got the news from Lam Research, also laying off hundreds, if not thousands of employees. We will see more and more and more layoffs. And of course, here's an update for you from a company that we heard from yesterday, Microsoft. When it rains, it pours. Microsoft cloud outage hits users around the world. And then how about an update for a name that reported earnings after the bell, Tesla the souffle? I'm kind of worried here that we will see a disaster in Tesla. Forget about today, forget about tomorrow. We know that advertisers are abandoning Twitter, not because they're cutting on spending. We know there is an advertising recession going on, but they're cutting spending on Twitter specifically because of Elon Musk, because Elon Musk wants freedom of speech. Now, Elon has to pay the bills somehow, and the only piggy bank he has is Tesla shares. He has to continue to dump. He has to take loans pinned against those shares of Tesla. The latest, $3 billion. If this trend continues, at some point we will see margin calls, and as a result, Tesla stock could get crushed in ways you couldn't even imagine possible. And then we got the news from Chevron after the bell announcing $75 billion worth of stock buybacks and dividend boost. This is where the money is, and therefore continue to be bullish energy. While you chase, of course, the RKKs of the world, the Shopifys, the Snapchats, good luck. And then we have another company here, Facebook Meta, after the bell announcing the former President Donald Trump is back, baby. Facebook, Instagram, he's back. Now, does that change anything at all? The answer is not really. I don't think Trump is going to move back to Facebook or Instagram. He's with his, what is it? Truth Social, I believe it's called. But anyways, what are the implications here? What does this say about Meta as a company? If I'm peeling the layers here, we have an advertising recession happening right now where companies are cutting marketing budgets big time. So what do you do if you're Zuckerberg? If you know for sure that advertisers are not going to spend anymore? You look ahead and you see what? You see elections spending hundreds of millions, if not billions of dollars. Now Trump is running, and with him, hundreds of millions of dollars worth of ads. And I believe this is why Facebook is allowing him back in. It's a sign of desperation. It's a sign that Meta's earnings will not be good. Now let's take a look at the heat map for the ETFs. Nothing to see here, really. We have a muted action across the board, flattish across the board, with the notable activities happening in international markets, be it muted, yet in the green. When we talk about developed markets, where we're talking about emerging markets, European markets, yet leading the gains today, the EWZ Brazil, and the laggard happened to be INDA India. Why is India down? The answer is we have the Adani companies. They all went down big, some by 7-8% in a single day. And the reason is we got a new research from Hindenburg accusing Adani of conducting the largest con in corporate history. Now, a lot of retail mom and pops, the geniuses that they are, when Hindenburg yesterday said, stay tuned, we're going to reveal the largest con in corporate history. And then they revealed that they're talking about Adani in India. The retail mom and pops here were disappointed. They thought Hindenburg, by saying they're going to reveal the largest con in corporate history, they're going to talk about Bed Bath & Beyond or GameStop or something. But folks, this is a major piece of news. We're talking about a guy who almost became the richest man in the world. We're talking about the hottest stock market in the world right now, the Indian market. And it's primarily led by the Adani companies. Billions of dollars poured from across the world into Adani holdings in India. Now, if the accusations are proven true, this could be one of the biggest corporate stories in history. Make no mistake. Now let's move on to charts and then wrap it up. And we start with SPY, the S&P 500, this time around an hourly chart. What happened today? A big gap down in the morning, and then we see the dip buyers showing up. And the SPY rallied all the way, closed the gap, and closed above the gap at the highs of the day. Now this action is bullish in nature, but it came on weaker volume. When you look at the RSI, it is still in negative momentum. So again, are you going to trust this now? Are you going to buy now? My answer is it's yet another trap. Not buying it, not chasing it. If anything, it gave us yet another opportunity to short. If you shorted today, closed the puts in the morning, they gave you another opportunity to short today and perhaps early on tomorrow. But you gotta watch out here. If the SPY rallies tomorrow, and it makes a higher high, then the message is clear. They want to fight the Fed all the way till the FOMC. And if that is the case, you don't want to short right away. You want to start building positions for the aftermath of the FOMC. Now, looking at the daily chart for the continuous contract for the S&P, what do we see here? We're back. Same resistance again, 4,037. Now, we have a slight negative divergence on the RSI. We have a MACD indicator that is flattening for now, be it positive. The volume moving higher by a little bit, which could be a warning sign. But all in all, back to the discussion of last night. We talked about how the market needs a piece of evidence to be granted permission to pass above 4,037. Did the market get any piece of evidence today, any new piece of evidence that perhaps justifies the comeback and the knock yet again, 4,037? The answer is absolutely not. But the market thinks that it got a new piece of evidence from the Bank of Canada, even though the Bank of Canada said clearly, we're not thinking about cutting rates. But the market for now wants to listen to whatever it wants to listen. Now, will 4,037 grant access to the chart now that it has a piece of evidence, quote unquote, from the Bank of Canada? We'll see what happens. But my hunch is that's not enough. On to the Qs, the NASDAQ, 30 minutes chart this time around. We see a massive gap down. The chart lost 284.30 only to catch a bid and rally all the way till the end of the day. Now, unlike the SPY, the Qs managed to close the gap but did not close above the gap. Are we going to make a big deal out of this? The answer is not quite. Not really, because it closed at the highs of the day, but still on negative divergence of the RSI, indicating weaker strength, weaker volume, and this is how traps are made. Here's the continuous contract, the daily chart for the NASDAQ. What do we see here? A crack below 11,689, but then a comeback. And the bulls are going to breathe a sigh of relief because had they closed the week below this number, it would have been a confirmation of a reversal. But we don't have that yet. Now, the volume moved higher by a lot because we saw initial selling in the morning and then the volume of buying the dip. Now, all in all, nothing happened. It's a move down and a rebound, indicating more appetite for dip buying. And the plan should be, if you see the chart moving higher by tomorrow, then they want to run it hot all the way to 12,207 and take their chances with the FOMC. And this is the bearish scenario. Pay attention now. If they move down again and they lose 11,689, that will be the bullish scenario. On to the IWM, the Russell 2000, 30 minutes chart. What do we see here? Perhaps a leading indicator for all SPY, Dow Jones, Qs, because we have a gap down. Yet the IWM rallied higher, closed the gap, and closed above the gap decisively. Yes, it is a negative divergence on the RSI in the 30, but it showed significant amount of strength. And if it is a leading indicator, is it saying that the Qs will also close the gap tomorrow and close above the gap? Something to think about. Now, I'm not going to say that the IWM is out of the woods until we see it closing above 188. Now, what about the Dixie, the dollar index, slightly negative for the day, but we're seeing the RSI weakening into oversold territory. Yet the MACD is holding ground and strengthening little by little. In other words, what is the Dixie saying here? It wants to pop, but it doesn't have a catalyst. It doesn't have the spark yet. Now, the spark could be coming from the core PCE on Friday or ultimately from the FOMC. Gold, the daily chart, what do we see here? Stalling, consolidating for now. It is getting overbought. It is running out of buyers. What happens when charts run out of buyers? The sellers at some point will show up, pull the trigger, and cash in some profits here, taking chips off the table before the FOMC. So I see a pullback here in gold, maybe all the way to 1895. That will be support number one in my eye. And then support number two will be all the way down to 1842. Now, if we see gold at 1842 and then we see the dollar also moving back down again, for me, that would be the buying opportunity for gold. What about Brent oil, the daily chart? What do we see here? Nothing new, flattish for the day. The same pattern continues. No update at all. The 10-year yield, the daily chart, any update here? Not really. Slightly negative for the day, but it is consolidating below the important level of 3.5, building a bull flag consolidation pattern. My hunch is both the dollar and the 10-year are waiting for a pop. They're waiting for the permission from Jerome Powell and the FOMC to pop higher and once and for all ending the market rally year to date. This is what I'm watching for. TLT, any update? Pop higher because the 10-year is down, but nothing significant here. It is still weaker in negative divergence than the RSI and the daily. So the assumption is, even if it rallies all the way to 109.5, it might actually form a double top formation and then go down. I doubt it will go all the way to 109.5 before the FOMC. I think we have a pullback and then a move all the way down, perhaps to 128 again, and then little by little the TLT builds another rally, which will eventually take it above 109.5. What about the VIX 4 hours chart? What do we see here? The momentum is neutral for now, slightly negative as you can see in the MACD indicator, but as if the VIX not making up its mind yet. For now, the trajectory is VIX goes down and a retest to 18, but it might rebound before that. And the reason why I say that, I'm looking at the MACD, I'm looking at the RSI, I'm not seeing significant and decisive crossing one way or the other. And therefore, I say we could see the VIX rebounding before a revisit and a retest to 18. Apple, 30 minutes chart. What do we see here? We have a double top at play that produced a gap down. But of course, the dip got bought and Apple rallied all the way, closed the gap, but it did not close above the gap. Now, the reason why I don't buy these kind of comebacks, look at the RSI. It is in negative momentum. In other words, this could be a fool's errand. It could be yet another trap. Not buying it, not falling for it, leaving it alone. If anything, I see it as an opportunity to short even more. Tesla, the souffle hourly chart, what do we see? Now, last time I checked, the souffle is up by about 5% or so after hours, but is it going to keep the gains? We have resistance at around 150, but the most important one, 155.25. We also have a trend line, and my hunch is, when we look at the RSI and negative divergence, let's say Tesla opened gapping higher. The RSI will become really overbought, and this could trigger the algos, and they could flush Tesla down, back to the neutral line, if not all the way down to the trend line. So my hunch is, my gut feeling says, gap and crap. Last but not least, what about Bitcoin Tulips daily chart? Perhaps the best piece of evidence that the bulls have for the continuation of the rally, because Bitcoin managed to crack above the important resistance of 23,189 without even going back seeking for support. But boy, is it getting really overbought here. And I know what you're going to say, overbought means nothing, Maverick. You're right, but it means what is the risk versus reward? Is the risk versus reward says go ahead and buy Bitcoin right now, and you know the moment you buy it, I'm talking to you. The moment you buy it, it flushes down right away. So please go ahead and do buy it. But all joking aside, let's say Bitcoin rallies from this point on and extends the overbought conditions. The next major resistance I see is 26,555. That could be yet another massive rally to come. Now, my 2 cents, I doubt it's going to get there. I think what they're doing right now is sucking a lot of bulls, sucking a lot of buyers, only to flush them down. Because after this big rally, if it continues for a little while, somebody who used to hold the bag is now back in the green, but in the process, the last few months, they learned the valuable lesson that Bitcoin is not investable right now. And what they're going to do is pull the trigger, take their profits, whatever left of the profits, and this is how the avalanche comes down, killing all of the new buyers who bought the hype. That's my 2 cents for now. Things could change, but for now, you can't really jump in it. It's too dangerous. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have plenty. We have initial jobless claims, we have GDP data, we have durable goods, we have the Chicago Fed National Activity Index on top of new home sales. Now, what do we have on the earnings calendar? We have Southwest Airlines, along with American Airlines, Rockwell Automotion, Dow Chemicals, ADM, Archer Daniels, Valero, Blackstone, Visa, and Intel. A lot of action tomorrow. We're not done yet. We're just getting started here. But folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Jumping out of an airplane is pretty straightforward.
And what about getting back into the plane?
I'd recommend a good travel agent.
Without it landing.